Good morning and welcome to the internet's only live daily housing show exclusively on BAM. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss existing home sales for May, Realtor.com's revised forecast for 2023, and the fate of office buildings. Today is Friday, June 23rd, 2023. I am Byron Lazine, and the hot sheet starts now. Good morning and welcome back to the hot sheet. Love to know in the live chat, if you're on YouTube, which market you are tuning in from this morning. And let's jump right into NAR's existing home sales report just released yesterday. Existing home sales edged higher by 0.2% in May. Okay, that's a seasonally adjusted rate of 4.3 million sales now, as reported by NAR for the year. So just up a tick on that number as well. Month over month, up again 0.2%. Year over year on existing home sales, is reported by National Association of Realtors, down 20.4%. Inventory, 2.6 months of inventory in May 2022. Now this year, up to 3 months. So you're starting to see a little bit more inventory accumulate on the market. Median sales price. We know median sale price isn't the best measurement that we have in this market, but it is a measurement. Median sales price is $396,100 for the month of May. Year over year, that is down 3.1% per NAR. So there you go on the snapshot of what's going on with NAR. Let's look at the Realtor Confidence Index survey, also put out by NAR. 28% of first-time home buyers were made up the market there in May. So 28% were first-time home buyers. Sales to investors, realtors said, was 15% of the market, where last May was 16%. Okay, so first-time home buyers up 1%. This May, sales to investors down 1% this month. Cash sales 25%, even with last May. Distressed sales up to 2% in May, where we had 1% last May. Days on market up to 18. Last May, it was 16. Still an incredibly low number for days on market. You can see here total existing home sales percentage change year over year. Again, down in May 20.4%, but it was down 23%, 22%, 23%, and then 36.9% the first 4 months of the year, going back through the months April through January in reverse order. Here's another way to look at this data, existing home sales from Calculator Risk Blog chart. For 2022 and 2023, you can see month over month, and this is seasonally adjusted, of course. You can see month over month the wide gap and disparity. January was well over the 6 million mark when this year in January, this was last January, this year in January, we were at 4 million. So you can see a slow increase here, and we're at 4.3 million right now, just up a tick from last month on the seasonally adjusted existing home sales. This is going to take a while to get back. I mean, I wouldn't expect anything like 6 million seasonally adjusted home sales anytime soon. It is going to be a slow month over month crawl back to 5 million. We looked yesterday. If you want to go back and look at yesterday's Mortgage Banker Association forecast, which just got us in 2025 getting into the 5 millions. I think you're just going to keep seeing a very slow crawl back towards that number. Okay, that would be my guess. Here's a chart from Calculator Risk that really puts this into perspective. This sales number into perspective. This graph shows existing home sales for each month. This is not seasonally adjusted for a few select periods. Okay. Black and light purple on this chart. This is, by the way, all of these charts that I'm sharing with you, all the sources, those are going to be over on BAMX. We're putting everything into one place for you. So join me on BAMX so you can get access to your daily download from the hot sheet as well as the live streams, courses, and everything else that we have going on. So the black and light purple are the maximum sales per month during the bubble 2005 and the minimum sales during the bust 2008 to 2011. And then we've got the 5 most recent years, 2019 through 2023. Okay, so 2023 is in red, and you can see that existing home sales in 2023 is like almost even every single month. It's a little higher in March, certainly. It's a little lower in April, though, a little higher in May this past month, but it's almost even overall with the bust years for existing home sales. So we're not seeing a bust in prices, but total sales, total transactions due to so many homeowners being locked into low interest rates and the interest rates being higher. And then, am I going to sell and move into something else? You're seeing similar amounts of sales from the bust years of 2008 to 2011 and today 2003. You can see the sales numbers in the bubble year of 2005 well above any total transactions that we experience, existing home sales, that is. So this carves out new home sales, but existing home sales for 2022 all the way going back to 2019. Okay, there was just an absurd amount of sales. So it got really hot. Well, we got hot this year, not to that level or this time frame, anyways, the last couple of years. So that's a real interesting chart there to take a look at and digest. I've got that down below for you in the BAMX link. So you just sign up for BAMX, you get access to all the daily downloads. Here's another way to actually look at existing home sales. And again, I think we're going to have a small or a slow crawl back to getting up over 5 million on the seasonally adjusted annual rate, which we experienced there for the years leading up to 2020. And then we shot up over the 6.5 million mark. We're starting to maybe find our bottom on total sales. Again, remember, if we had something that like an interest rate go to 8%, it's a little projects we go right down to 3 to 3.5 million on this number. That would be well below that 2008 to 2011 time frame. We're not at 8%. There's not a projection that 8% is coming, but that's where they believe we would end up if we do hit 8% on the 30-year fixed interest rate. Here's the median price of existing home sales, showing us the slight drop year over year, $396,100 today, well above the 2019, 2020 level of 274,500, of course, with all of the home price appreciation that we have experienced. So that's what NAR has. I'll put everything down below. Again, BAMX is the one place to get all of that. Total housing inventory as tracked by NAR, again, up a little bit. It was 1.08 million units in May. That's up 3.8% from April. It's down 6.1% from a year ago when we were at 1.15 million. Remember, NAR tracks total inventory on active homes on the market, as well as the pending sales, the sales that are in escrow under contract. Okay. Unsold inventory is sitting at that 3-month supply, which is up from 2.9 months in April. So we're starting to see, this is good. We want inventory to go up. Okay. Starting to see a little trickle up, and it's up from the 2.6 months in May 2020. Lawrence Yoon, the chief economist for NAR, says available inventory strongly impacts home sales too. Newly constructed homes are selling at a pace reminiscent of pre-pandemic times because of an abundance of inventory in that sector. However, existing home sales activity is down sizably due to the current supply being roughly half the level of 2019. We have over 7 months of inventory on newly constructed homes, where the median price point sits above the existing home sales median price point sits above 450,000. The average price point on newly constructed homes is sitting over 550,000 for the country. All right. So NAR is saying year over year median prices are coming down. They're saying that inventory is going up, and that's their May forecast. They also said that distressed sales went up, right? So 2% of sales in May, unchanged from last month. but up 1% from the year prior. Listen, that's like basically nothing. We know that. There's a regional breakdown in there too. Existing home sales in the Northeast declined 2% from April to an annual rate of 500,000 in May, down 25.4% from May 22. The median price point in the Northeast was 439,000, which is up 2.5% from a year ago. So Northeast prices year over year on the median price point measurement are up. Midwest existing home sales faded 2.9% from 1 month ago to an annual rate of 990,000 sales, decreasing 20.8% from the previous year. The median price in the Midwest is 298,000, also up 1.1% year over year. Okay. The South is down 2.7% on median sale price year over year. They expanded, though, from April to May on an annual rate of sales at 1.5%. They slid 16.5% from the year prior. In the West, existing home sales also rose 2.6% from the previous month. It's down 25.5% year over year. And the median price point in the West was $596,500, which is down 5.7% year over year. Okay, so there's your NAR macro and then regional outlook. Love to know in your market, what some of those measurements look like. What does median price point look like, up or down year over year, and months of inventory? Love to know that number from you as well. Realtor.com also came out with their numbers. In fact, they updated their economic forecast for 2023 with their mid-year update. They said despite easing home prices, costs remain high. So Realtor.com is also saying, hey, home prices are easing. Mortgage rates have been revised modestly lower to reflect a steep drop in late 2022 that carried over into 2023. Inflation is expected to cool only gradually. So they're taking the Jerome Powell stance. Hey, inflation is going to be slower than we might hope. Mortgage rates will follow suit with the gradual decline beginning mid-year that could bring rates near 6% by year end. Remember, Mortgage Banker Association believes at the end of the year will be just under 6%. We talked about that on yesterday's hot sheet. Go back and re-listen or listen for the first time if you missed that one. So let's take a look at some of these Realtor.com variables. I have a table in BAMX for you in the daily download, so you can grab this. There's some interesting data points in here. So Realtor.com on the left here, we have 2023 forecast revised, and in the middle line we have 2023 forecast that they originally put out in November 2022. Okay, so interesting here to compare from where they're at mid-year to 2022. In 2022, mortgage rates, they said, would average 7.4% throughout the year, and that we would end this year at 7.1%. That's what they said in November. This is Realtor.com, okay? Now, what we've actually seen here is, an under 7% for most of the year. I mean, we've touched between 6.5% and 7% for a good chunk of the year. But now the revised forecast is a full 1% lower on the 30-year fixed rate. It's 6.4%, and they believe will end the year at 6.1% on the 30-year fixed. Okay. 2022, of course, the average was 5.3%. But we ended the year at 6.7. So they believe we'll end the year a full 0.5% lower than where we ended the year last year. Now they're calling for 6.1. Back in November of 2022, Realtor.com was one of the most bullish on home prices. On existing home median sale price appreciation, they had us at 5.4% up nationally. Now, Realtor.com is saying at the end of the year, our existing home median sale price appreciation is going to be negative 0.6%. So Realtor.com is now saying, well, we're not going to see home price appreciation in 2023. In fact, we're going to see a slight dip. Mortgage Banker Association yesterday, when we looked at their revised outlook, they had it at 0%. They had it flat. There are others that are saying 0% now too. Zillow not in that camp, right? Zillow's up, Realtor.com down. to negative 0.6%. One of the few that is actually has a revised forecast in the negatives, not a full percent, of course, so not by much, but a huge change from where they were in November 2022. Existing home sales, okay? In November 22, they had us at a projection for 23 of 4.5 million for existing home sales. Now they're saying that number is going to be 4.2 million. Okay, so pretty close there. Of course, 2022's data was 5 million home sales, so well off of that number and well off of 2021, where we were up over 6 million. Existing home for sale inventory. Okay, so Realtor.com had us up 22.8% on November 2022 for their projection for this year. Now they're saying they revised it to being down 5%. Okay, huge shift on existing home for sale inventory. So they totally missed that one based off of the data they've collected the last 6 months. Single family home housing starts, they had us at 0.9 million. They've revised that to 0.8 million, so they're pretty close there. They feel like home ownership rate unchanged, 65.7%. That's where they've got us. And then rent change, they had it up. This is the big one. This is the one I keep talking about. This is going to help us hopefully educate the Fed on, not driving a labor stoppage by continuing to jack up these interest rates. You got rent change, which makes up the majority of inflation. They were projecting the beginning of the year being up 6.3%. Now they're saying down 0.9%. That's what we're seeing across the board. All right, this table is available for you. Pretty interesting data here from Realtor.com. Pretty interesting shift from their projections on some of these indicators from where they are at today, as they've got 6 months, almost 6 months of data, and they're projecting out here for the rest of the year. Again, you can join me in BAMX and grab that down below on our daily download. Every day, it seems, we have another report about commercial real estate. This I believe would be the only contributing factor from the real estate sector that could put us back into a great financial crisis situation. Bloomberg this morning, their lead headline was this: the world's empty office buildings have become a debt time bomb. From San Francisco to even Hong Kong, higher interest rates and falling property values are bringing the commercial real estate market to a perilous precipice. Okay, so New York and London, owners of gleaming towers, are walking away from their debt. So you've got big investors who own office buildings in some of the most iconic cities in the world just walking away from these assets. That's interesting to think about. People don't just walk away from a big asset unless they think there's something that is catastrophic happening, or that they'll never make the money back, or that they can take that money and put it somewhere else. Major institutional owners, including Blackstone, Brookfield, and Pineco, have already chosen to stop payments. This is Blackstone, more money than anybody. Stop payments on some buildings because they have better use for their cash and resources. It's crazy to think about that. Blackstone is saying, hey, we're just going to stop paying our bills, paying our mortgage on some of these buildings, right? There's significant stress, says Harold Bordwin, a principal at New York at Keene Summit Capital Partners, LLC, which specializes in renegotiation of distressed real estate. People don't give up. This is his quote: people don't give up assets so easily unless they don't see any hope and they recognize that they're pretty well underwater. For those of us that went through the great financial crisis, those years that I just outlined in the calculated risk chart, where you remember 2005, you remember the run up, and then you remember what happened in 2008 to 2011. How many homeowners said, you know what, I'm easily willing to give up my house either on short sale or through foreclosure / bankruptcy. There was a lot of homeowners that were willing to do that during those years because they couldn't see an end in sight on getting their value back that they had in. There were many homeowners that were down 80% in some areas of the country. And they said, you know what, screw it. I can't cover my costs on the rent. Everybody's losing their jobs. And it's going to take me a decade plus to even break even on this property. I'd be better off over the next 10 years taking my money and putting it to work somewhere else, and I could catch up in 5 years on the hole that I'm in. This is what's now happening to commercial real estate, where investors as big as Blackstone are making the decision to stop payments. If Blackstone's doing that today, how many smaller investors tomorrow, next year, are going to make the same decision? The number of transactions is plunging. And when deals do happen, the price declines are stark in the US, where return to office rates have been lower than Asia and Europe. Interesting. Europe higher as a return to office rate. Values for institutional quality offices are down 27% since March 2020, when interest rates started going up. According to data analytics company Green Street, apartment buildings prices have declined 21%. Okay, so even apartments now in these cities that are around office buildings, they're feeling it. Malls are off 18%. Office prices are expected to fall more than 25% in Europe and almost 13% in Asia region before hitting a trough. PGIM Real Estate Unit of Prudential Financial Forecasts. They also forecast that the great reset of values for office buildings and commercial was likely to be really slow, agonizingly slow, they put it. It took 6 years for U.S. office prices to recover after the 2008 financial crisis. Of course, that was a residential crisis, but this time we think it'll take 10 years. Richard Barkham, global chief economist for CBRE Group. That's kind of in line with, we reported that Wall Street Journal article. I think it was a Columbia report. They reference it here in this Bloomberg one too. The Columbia study that said New York City office buildings will be down in value by 2029 at 44%. So what they're saying is, as we work through this, it's going to take a long time to see the bottom. So you're seeing prices plunge right now. We're going to talk about San Francisco and some other major cities here in a second. You're seeing prices plunge in San Francisco and other cities. But what they're saying is that's not the bottom. They're saying the bottom could be 5, 6, 7 years out. Prices year over year in commercial and specifically office buildings are going to continue to decline year over year. So coming in now thinking you're getting a deal might be a very risky move if you're going to buy San Francisco or some of these other major cities where their property values are going to be distressed. San Francisco is the most pronounced for this problem, where a downward trend is gathering momentum as one building after another slips into default. Property prices in the tech hub reached record highs in the past decade, so they had a long way to fall. The city boomed with hot startups, obviously Airbnb, Twitter, Uber, Facebook, Meta, all of these companies, along with established giants such as Salesforce. Now, many of them have cut jobs and even office space as well. The downtown is struggling to reattract employers and employees who've flourished working remotely. Okay, so if we look at San Francisco here, just specifically square footage leased per quarter, you can see the downward trend, and there's not a lot of signs that that's going to go up. You can see here quarter one, square footage leased per quarter in the millions was under 1 million, where if you go back to 2018, they were at 3 million. So they're less than a third of where they were at quarter two of 2018. And really, they hung up close to 3 million. They started to see a decline before 2020, but then 2020 just exacerbated the problem for San Francisco office building. Okay, the largest mall in San Francisco, you may have seen this report this week, the once fashionable Union Square district, the city's largest mall, Westfield San Francisco Center, in June, this month, handed its keys over to holders of a $558 million mortgage. They said, okay, we got a $500 million mortgage. We don't want the property anymore. Nordstrom announced it was shutting its department store in the complex, and that was the last straw that broke the camel's back. With tourism slow to rebound from the pandemic, Park Hotels Resorts Incorporated has also stopped payments in San Francisco. That's on $725 million in debt, tied to two of the city's biggest hotels, Hilton, Union Square, and Park 55. Veritas Investments, a major local landlord, defaulted on 675 million in debt on a portfolio of, wait for it, apartments. Who the heck would default on apartments? But when you've got the mall moving, saying, hey, we're done, we're not getting enough foot traffic here in the mall. You don't have people in these office buildings. You probably have people leaving the apartment. So Veritas Investments is saying, hey, the future of my vacancy rate looks higher on this apartment. Let me walk away from 675 million in debt on apartments, which are supposedly the safest asset to own. By the way, the portfolio was valued at over 1 billion in 2020. So if you only got 675 million, real estate's gone up, right? Since 2020, real estate has appreciated. But they walked away from 675 million in debt. They obviously feel like the value is less than the 675 million, or they wouldn't have walked away. The loans right now are on the market with no buyer. So an apartment building, a portfolio of apartments in San Francisco is maybe worth less than half or about half of what it was worth in 2020. We don't know. We'll have to wait for the $675 million in debt on this portfolio of apartments to get bought to see what the value of these apartments are. But it's a significant decrease from where it was in 2020 when real estate, has gone up almost everywhere else. The office vacancy and availability rate has tripled from pre-pandemic days. And one of the city's few office deals, Wells Fargo, recently sold a 13-floor tower. We talked about this for $200 per square foot. The 2019 market peak was $1,000, according to Newmark Group Incorporated. Okay, so there's no way to avoid this price reset that is coming. Says David Bittner, an analyst in San Francisco for Newmark. Office is bearing the brunt, but there's also older retail and more recent multifamily that is being affected. The city's coffers are taking a hit. So the mayor is projecting a $780 million 2-year budget deficit. She wants to diversify downtown, including conversion of more buildings to housing. Listen, office buildings are boring. A lot of these 1990 office buildings are boring. You come up the elevator, long hallway, office buildings. Okay, I don't know how you renovate that to attract people that want to be there and live there. It's going to be costly to take office buildings and turn them into residential. So when I hear costly, I automatically think luxury renovations. I don't think your luxury buyer wants to be in an office building in the middle of a downtown when they don't have to be there. So the whole conversion argument to me is rather silly. It's not a solution. I don't think it's a good long-term plan. New York City streets right now, I first guessed this back during the middle of the pandemic when everyone said New York was dead. You go to New York today, the streets are bustling with tourists and residents. But what I didn't maybe see coming was only about half of the office workers are back at their desk. This is according to building security company Castle Systems. Scores of buildings are struggling with the loss of tenants and the need for upgrades right now. Employers work out their updated office needs. They can choose spaces in newly built towers such as Hudson Yards or Grand Central Terminal rather than some of these aging properties. So this isn't the vacancy rate of leases. This is only 50% of the lease spaces have workers in them. So workers aren't coming to the lease spaces. Now, Mortgage Banker Association says that there's 1.4 trillion coming due between the end of this year and the end of next year on these mortgages here for commercial real estate. That is not going to be good. Right now, you're hearing a lot of this, and there's a bunch of examples in this Bloomberg article. Hey, they bumped out developer GFP Real Estate, for example, received a 2-year extension on the Dumont building, the Art Deco, and the Madison Tower after being unable to pay $103 million mortgage when it came due. You're going to keep hearing this. We're going to kick the can down a year. We're going to kick the can down a year, see if people come back to work. The New York City Mayor, Eric Adams, is saying we need a wider return to the office, urging Wall Street leaders to enforce in-person work. Offices expect to reach a record 22.7 vacancy rate this year. So the vacancy rate's the leases, but only 50% of what's even, has a lease on it sees workers going into it, according to that Castle Property Management Group. Offices expected to reach this 22.7 vacancy rate typically account for 20% of the city's property tax revenue. New York City, one of the highest places, most unaffordable when it comes to taxes in America, is now going to be at risk of losing a good portion of this 20% tax revenue. These buildings values keep going down. There's going to be this reset coming, and then that's going to be less tax income. So of course, Mayor Eric Adams is saying, get back to work. He's on the Elon train. He's on the Jamie Dimon from JP Morgan train. Get back to work because we need to maintain this income, this revenue stream from the office buildings. Okay. I mentioned the New York University and Columbia University found that offices in New York City will lose 44% of their pre-pandemic value by 2029 because of the impact of remote work, which is seemingly taking over almost every company in America. Office availability rate in selected downtowns. This is today. This is now. San Francisco, 32.7%. Houston is at 32.5%. Atlanta, 31.1%. Los Angeles, almost 30%. Chicago, 26% plus. Seattle, 25% plus. Philadelphia, 22% plus. Washington, almost 22%. New York was 19.5% in quarter one. Now it's up to 22.7% like that here as we move through quarter two. Boston at 17.4%. Okay, so there's a lot of offices available, and this isn't telling the whole picture. A lot of people have put a Band-Aid on, kicked the can down the line for a year. Again, I'm in belief here right now that this could be the biggest issue that we're faced with as an economy over the next couple of years as we try to combat with the bank situation, what's going to happen with all of these loans, trillions and trillions of dollars in loans. And it seems like every day more information comes out about this. This commercial, specifically office building sector, is starting to feel to me. I went through the great financial crisis on the residential side. It's starting to feel like that story. Okay. People like Blackstone walking away from their loan. It's starting to have that feel. Let me know what you think down below in the comments. Taking a look at a week of uncertainty here, as Jerome Powell testified this week twice, and has said we're going to raise rates again. You've seen markets just kind of really be a little bit stagnant, and the 10-year Treasury has reflected that. We are down 0.082 today, which is good. So we're off of the high 3.7s now at 3.714. We'll see what that does to the 30-year. Hopefully we get a little bit of a decline today as we go into the weekend. Yesterday we ended on let's just refresh this here. Not refreshing. Okay. I think we ended at 695. All right, was the number I saw yesterday. So we did end up slightly up yesterday. I don't know what's going on here. I have like Tom Tool internet hitting me. Speaking of Tom Tool, we'll have a new Knowledge Brokers podcast today at 2 p.m. over at Knowledge Brokers Podcast on the channel. And we're going to be doing a draft. Myself, Tom, and Lisa, we're going to be drafting our top 6 books for real estate agents. So if you're a real estate agent, these are the top 6 books that you want to get. We're going to be talking about that in the podcast, and then everything that happened here this week in the economy, and of course in housing. That's at 2:00 over at Knowledge Brokers Podcast. Yeah, yesterday was 695. Of course, with the 10-year down today, hopefully that'll tick back down, maybe even under 6.9. Who knows? We'll see. Join me over in BAMX so you can get your access to all of the daily downloads as well as all of the courses. Tom Tool has a great objection handling course, as well as the live streams in the private community. Hope everybody has a great weekend, and I'll see you back here Monday live at 9:30 Eastern Time, 6:30 Pacific Time. Till then, toodaloo.